Very good morning to all. So today we are going to discuss about financial management. Okay, what is finance? I hope you know what is management, right? It is getting things done through by others, or it is a process of planning, organizing, staffing, directing, and controlling, right? So the same way, what is finance? Finance is defined as the management of money and includes activities such as investing, borrowing, lending, budgeting, saving, and forecasting. So, what is investing? Anyway, that is not the first job of finance. The first job is sourcing the money from various sources. For example, equity capital from equity shareholders, preference capital from preference shareholders, debentures from debenture holders, bank loan from bankers, and so on. So this is what given here as borrowing. Understood? Okay. So once the money is borrowed, so let us assume that you need 10 crore for your business and you got it. All right. So now the money you received from different sources is with you. Now you need to plan for the investment. So which investment avenue is giving the best return for my money with taking minimum risk, right? So that is investing. Lending, right? I am having surplus of amount, so I am investing somewhere, right? Borrowing, I am having deficit of funds, so I am borrowing the money. Budgeting, what is budgeting? Budgeting is the blueprint of future financial plan. Understood? For example, the next 1 year, what is your income? What is your expenditure? What is your plan for investment? Correct, that is budgeting. Okay. Saving, is there any difference between saving and investment? Is there any difference between saving and investment? Yes, both are not same. When you are talking about investment, you are taking a risk and taking higher return is the motive. Correct? In case of savings, you don't think about reaping more profit, but you are thinking about the safety and the security of the capital invested in the particular scheme. That is called saving. That is why the money in the bank it is called saving, not investment, because there is no risk when you deposit money in the bank. Though there is a risk, it is only the minor degree of risk. Maybe a 0.5 percentage to 1 percentage you may lose. Sometimes 0.25 to 0.5 percentage you may reap extra benefits. But where is the risk? There is no much risk you can experience from depositing the amount into bank. But people are talking about mutual fund investment, share market investments, real estate investment. What happens here? You are taking a degree of risk to reap maximum profit. Any idea what is the percentage given by bank savings for your recurring deposit? Let us say. So it is 6.25 percentage to 9 percentage, depends on the category and depends on the period you invest the money. So per annum 6.25 percentage, do you think is that sufficient to fight with your inflation? Question mark. Definitely no. If you want to fight with inflation rate, you should try to reap 2 percentage per month as interest. So 12 months, 24 percentage should be your return. The same case, come to real estate or mutual fund or share market, but you are taking a risk. What is the risk here? You may either get a huge loss or get a huge profit. So when the situation seems like you are going to get a huge loss, you are not supposed to sell the property unless otherwise you are in a financial crisis. Understood? So in case of share marketing, you can reap twice the amount within a year. There is a possibility. In case of mutual fund, it takes 3 to 4 years to become double. In case of real estate, depends. If there is any government project comes nearby, definitely your asset value become double, triple. Correct? But there is a risk involved. It is not like bank deposits. Understood the difference between saving and investment? Hope it is clear. And there are three types of finance. There are three types of finance. One is personal finance, that is managing your own, that is individuals' income and expenditure. That is called personal finance. Number two, corporate finance, managing corporate assets, managing corporate receipts, corporate payments. Okay, where to source the fund, where to invest the fund, how to reap the maximum benefit, how much will be the dividend, how much will be the retention ratio. So all those things will be calculated. That is corporate finance. So what we are going to touch here is a basics of corporate finance. That's what the syllabus talks about. The last one is public or government finance. So it is about the government revenue and government payments. So what are all the sources of revenue for the government? What are all the payments the government made? Correct? So this is called a type of public finance or government finance. But if you take every finance, it is a version. So personal finance, corporate finance, or it is a government finance. Okay. Individually, every type is a version. So what we are going to explore much is a type of corporate finance. So being an executive in a corporate, how to make use of the skills you learn in the subject matter and how to make fruitful efforts in the real world. Clear? Meaning of financial management, it means planning, organizing, directing, and controlling the financial activity such as procurement and utilization of funds. Remember, it is about procurement of funds, that is source of funds. Utilization of funds talks about where to invest the fund and how to get maximum profit. It means applying general management principle to financial resources of the enterprise. Very simple. What are all the general management principles? Planning, organizing, directing, and controlling. So these are the general management principle you are applying in the field of finance. Understood? Examples of financial management. Investing personal money in stocks, bonds, or guaranteed investment certificate. Borrowing money from institutional investors by issuing bonds on behalf of a public company. Lending money to people by providing them a mortgage to buy a house. Saving personal money in a high interest savings account. Developing a forecast for government spending and revenue collection. Everything is a different types of finance which you have seen in the slide number one. So investing your personal money in stocks refers to shares, bonds, otherwise called debentures, guaranteed investment certificate. So when you are investing personal money and managing it, it is called personal finance. Correct? The first one belongs to personal finance. I mean this one. So this one refers to personal finance. Second one, borrowing money from institutional investors. That is one corporate company investing in another company. Right? This is a type of corporate finance. Understood? Third one, lending money to people by providing them a mortgage to buy a house. It is like a housing finance. Again, coming under corporate finance. Because the company which is giving money is a corporate, but people who are getting it, it's a personal finance. So here we are talking about again corporate. Saving personal money in high interest saving account, that is a type of personal finance. Developing a forecast for government spending and revenue collection. The clue is government spending and revenue collection. So it is public finance. Hope you understood three different types of finances with the examples we are given. We'll move on to the next slide. Okay, needs of finance. Why finance is required? Before getting into why finance is required, let us discuss on what is accounting and what is finance. Because so far, from your schooling till the first year of your BBA, You could have studied about accounting, correct? So you people have to remember what is accounting. Accounting refers to recording all day-to-day activities of a business, correct? Recording all day-to-day activities of a business, classifying, recording the business activities, that is called accounting. It is a type of post-mortem activity where something happened, after that you started recording everything. Am I right? Are you all with me? So it is something has happened already. After that, you record so and so expenditure or so and so revenue happened. That is accounting. What is finance? Finance is a blueprint of how you are going to get revenue and how you are going to spend it. That is finance. So your accounting is about past, finance is about future, correct? How much money I will collect in the month of May, June, July? What would be the expenditure? How much money I will be having left over at the end of every month? What is my closing balance of cash every month? So this is finance. Clear? Accounting is past oriented, finance is future oriented. So every business need to think about their future, correct? Not about past. Past they can use to see where they got their own traps. But future business is a blueprint of the activity which is going to happen, correct? That is why finance is highly needed in any business. Okay, finance to start a business. Yes, to start a business, you should have money and you should have plan about where the money is coming from and how you are going to invest in different avenues and how you are going to reap the benefits. That is return on investment. Finance for the purpose of expansions to production capacity. For example, your present production capacity is 80 percentage or 70 percentage. Future you want to increase it up to 95 percentage. So you need additional capital, right? So you need to plan for it. Where to procure those additional capital? Probably not from the existing borrowers. That's why you can look at practically you can look at corporate companies. They will be getting loans from 2 to 3 bankers. Why? The single banker cannot give repeated loans. There is the regulatory body for banking. It says that this is the maximum limit for a branch. Correct. So for production capacity expansion, where the finance comes from and where the machinery comes from, he will get 3 or 4 quotations and evaluate using some financial tools, right? Then he will go for the project which is viable. So that is how finance help you to expand production capacity, to develop and market new products. So to develop a product, that is to develop a new product, you need finance. To market the new product, you need finance. So without money, nothing happens, right? Money is otherwise called finance. Even other way around, we could say that. To develop a new product is the one which is not available in the market. And as a pioneer, you are doing research and development to make such a product in the market. Any innovative product, you can call it as new product development. A pretty old examples I could say is GeoSim, Tata Nano, for your understanding. Okay. Then to enter into new markets, we need finance. For example, you are producing, let us say, liquor. Okay, you are producing liquor and you want to enter into new market. What is the new market? It may be a new product vertical like FMCG, or you want to enter into a new region, that is also called new market. For both the purposes we need finance. Takeover and acquisition or merger. Takeover or acquisition both are similar. Example, company A takeovers company B. It means it buys company B. Company A buys company B. So the entire liability and asset of company B goes to company A. Company A take over company B. Then what is merger? A and B join together. Company A and company B join together to do the business. That's called merger. Example, Maruti Suzuki, Hero Honda. So these are all mergers. Acquisition or takeover. Mahendra Satyam. Take that as example. Mahendra Satyam. Moving to new premises from the current premises to you are moving to a new office. So you need finance again. Because you need to pay advance, you need to pay some running expenses before getting into your new office. Right? To procure raw material, to pay salary, everywhere money is required. Simply think that money you will write everything easily. To pay the day-to-day running of business, that is to pay off the working capital. We need finance. What is working capital? Day-to-day expenditure of the business. Otherwise called in terms of formula. What is that? Current asset minus current liability. Clear? Choosing the right source of finance. So far we thought about different sources of finance, right? Equity capital, preference capital, debentures, bonds, loans, etc. So you need to choose the right source of finance. What is that right source of finance? The source of finance should not eat up all your profit. Try to remember that. The source of finance should have the low cost of capital. What is low cost of capital? For example, there are two projects. There are two sources of finance. Bank A and Bank B. Bank A ready to give you 5 crore and Bank B ready to give you 10 crore. And Bank A interest is 10 percentage and Bank B interest is 20 percentage. So which one you need to go? Probably the Bank B gives you 20 percentage of interest. That means you are going to pay the 20 percentage. The loan attracts 20 percentage interest. Though they give double the debt amount, you should not go for that because it eats up the profit. The same case, Bank A gives only 5 crores, but 10 percentage interest, it could be okay. Though you are in need of 10 crores, you approach another bank which can give you the additional 5 crore with the same rate of interest. Got it? How to find the right source of finance? The loan which you borrow or the equity capital which you get from investors should make you to grow. It should not dry up your return on investment. Correct? Always the cost of capital should be less than return on investment. So I invest 1 crore rupees. This 1 crore rupee which I received from different investors. Now I get a profit of rupees 20 lakhs, for example. Now I get a profit of rupees 20 lakhs. If my cost of capital is 10 percentage, so what is 10 percentage of 1 crore? 10 lakhs. So I got 20 lakhs, I paid 10 lakhs, 10 lakhs in my account, correct? Other way around, I got profit 20 lakhs out of this 1 crore invested, but my investor wants 25 percentage profit. So what do I do? They need 25 lakhs out of my investment. So I'm going to borrow 5 lakhs and ending up no cash at hand. Clear? No reserve at all. So choose the right source of finance always. There are so many people in the market who are ready to push money into your business. Remember, many people will close your business with their money. Clear? That is choosing the right source of finance. Importance of finance. Number one, generate money. That is source of finance. Generation of money. One angle. Another angle, return on investment is also called as generation of money. So all the ways money is coming inside to the business, it is called generate money. Organize operations. Okay. What are all the operations in finance? It is not about your production department, it is operations in finance. As I said, where to get the money? What are all the investment avenues available? In which investment avenue? How much money I have to invest? What is the risk involved and return we get from each and every investment avenue? Correct? Finally, whether I am getting the right investment or not, control mechanism. As planned, whether I am getting return or not. Okay, managing the cash flow. It is very simple. You studied in the last semester cash flow management, right? It is managing cash flow. That is cash inflow and the cash outflow calculation. That's it. That is computation of cash inflow and cash outflow. Then strategize funding. That is from where you need to get the fund. That is called strategize funding. For that, you need to have sound financial knowledge. Otherwise, it's tough. Outline the long-term goal. So you should know what is long-term goal. Based on your long-term goal, you should plan for your short-term goals. For example, I want to produce 100 unit in 100 days. Correct? If that is the case, every unit in a day I need to produce. Correct? Every day I need to produce one unit. So this 100 units is 100 day, 100 units in 100 days. That is called long term. Short term is for a single day plan or a single week plan. Correct? Medium term, every month plan. That is medium term in this case. To sustain economic downturn. What is economic downturn? So whatever we are enjoying right now in the COVID period, it is called economic downturn, where there is no business, no new avenues. People like to save the money. People like to be tight fisted. Correct? Everybody now doing budgeting before spending it because the source of money has stopped it. The economic activity comes standstill, but still there is an opportunity for people even in this market. That is like opportunity in difficulty. So always have some positive attitude. This is not a permanent one. So this phase will go away. So economic downturn where the business faces financial crisis or the business faces phase of sickness. That is, it is not able to run as it was earlier. Okay. When there is an economic downturn, only those institutions which are having very sound health in finance will survive. The company which had a lot of resource and surplus, lot of retained earnings with them, these companies will survive. The company which didn't have any good financial plan will lose the business and come to the closure. Understood? So finance is important to survive in economic downturn, recession, slowdown market, whatever. Clear? Types of finance under corporate finance. These are the different types: business finance, agricultural finance, investment finance, development finance. So this is four types. These are four types under corporate finance. Number one is business finance, deals with rising, controlling, and administrating funds used in the business activities. Agricultural finance refers to funds needed and supplied for the development of agricultural activities. So, agricultural finance. The next one is investment finance, deals with purchase and sales of shares and bonds. So, those guys who are sitting with share market and debenture market, those investments are called investment finance. Development finance represents funds needed for development. It includes both agricultural and industrial finance. Okay, business finance, any commercial banks does it. Agricultural finance, the bank which is specialized for agriculture like NABARD, rural banks does it. Investment finance, no bank finance you for investment in share market. But investment finance companies will manage your finance. Correct? Like Sharecon, Angels, these are all asset management company coming under investment finance. Development finance represents funds needed for development of business, like IDBA, Industrial Development Bank of India, IFCA, Indian Financial Corporation of India. So these banks are especially started to develop industries. Is that clear up to this point? Okay, traditional approach of finance is concerned with the raising of funds and used in enterprise. It is only fundraising and used in the enterprise. That's it. There is no other activity. But it covers the following: procurement of short term, medium term, and long term funds from different sources of financing institutions. So, short term fund within a year, medium term fund 1 to 3 or 1 to 5 years, long term funds 5 to 10 or 20 years. Understood? Funds are raised through financial instruments like, as I said, equity shares, preference shares, debentures, bonds, bank loan, etc. Redistribution of income and assets among these resources. So once you collect money, it appears in your liability side. Am I right? Once you source money using different sources, for example, if you get 1 crore rupee from equity shareholders, it appears as equity capital in your liability side, correct? Balance sheet. Preference shares, debentures, bonds, etc. Everything in the liability side. But how assets are created? That is redistribution of liabilities to assets. What is that? For example, let us assume that equity shareholder paid me 1 crore rupees. So in that company, only equity shareholder, no other source of finance. So equity shareholder paid 1 crore rupee. Okay, 1 crore rupee he paid. So what happens in the asset side? 20 lakh rupees I buy a fixed asset. 30 lakh rupees I buy machinery. Uh, Another 20 lakh I keep it as cash. Another 30 lakh I invest in other businesses. Correct? So now 1 crore tallies. This is how the sources of capital is distributed as assets. Understood? That is why we always say liability equal to assets. Modern approach. The converse to traditional approach, modern approach rise. This approach not only includes raising funds and administrating it, but also includes investment decision, financing decision, and dividend decision policies. So these three decisions were not there with the traditional approach of finance. Let us see the modern approach of finance. Investment decisions. It has to be made with regard to utilization of funds in one activity or the other. It involves the following: determine the total investment employed in the business. Okay, how much total investment we need to run the business? Point number one. Point number two: determining the size of investment in permanent asset, that is fixed asset. Correct? Determining the size of investment. What is the size of investment? For example, out of the 1 crore rupee, fixed asset is land and building, and machinery, correct? For example, if that is the case, in the previous example which I told, I have given 50 percentage of size of investment to permanent assets, correct? Deciding about allocation of funds to each investment proposal, for example, as an investor, you are going to invest in others' business. As an investor, you are going to invest in other business. I will give you a case study. Listen keenly, otherwise you will not understand the concept. Listen. For example, you are having 1 lakh rupee in hand. Okay, there are two business opportunities which is having the same risk and same return. Let us assume that 20% risk and 50% return. Both business asks you 1 lakh rupee, but you are having only 1 lakh rupees in hand. So you need to decide in which business you are going to invest that. That is allocation of funds to each investment. Okay, business number one, that is lemonade, making lemon juice and selling it in the street. That is lemonade business number one. Number two is chocolate business. So now you decide which business is better for you. So take 10 seconds and decide which business is better for you. Okay. The people who thought about lemonade business are failing to do a good judgment because it's a seasonal business. Only in summer season people used to consume it more, but when it comes to winter or rainy season, they will not buy the lemon juice business. Other business, chocolate across the year by the children, correct? So you need to decide which investment opportunity which gives maximum return. So in terms of percentage, both are same, but in terms of amount, both business will vary, correct? Evaluating of investment in respect to risk and return. Let's think about these two concepts, risk and return. So your return should be more when the risk is high. That is high risk, high return, medium risk, medium return, low risk and low return. Is that clear? Deciding about the finance performance of each activity. Okay, what are all the activities they're talking about? Financial performance of each activities refers to you invested in 5 companies, for example. You are dealing with share market. You invested in 5 companies. So each company activities you have to assess. So that which one would be better? You know that. And with the company, which one is not performing well, take off the investment and put it into the right company. Deciding regarding optimum capital structure. What is capital structure? What is capital structure? Capital structure refers to debt capital and equity capital mix up. That is called capital structure. Any balance sheet of any company you take, there will be a debt capital, there will be equity capital. It should be in the right proportion to reap the maximum return out of it. And again, the right proportion depends on industry, depends on the type of business, nature of business you are doing. Correct? That is what deciding regarding optimum capital structure. What is the proportion of debt capital? What is the proportion of equity capital? Right? Financing decision. It refers to how the total required funds or get by the firms will be made available through the financial instruments such as issue of shares and debentures. It includes the following: determining the best capital structure of the firm. That is again they're talking about debt equity mix. Okay, determining the best capital structure of the firm. So there are different theories talking about the capital structure that we will see in the forthcoming units. In that time, you will understand what would be the optimum capital structure or best capital mix. Now, just a capital structure, just remember that it is debt capital and and equity capital mix up. That's it. Determining optimum proportion of equity and debt capital, we explained already this point. Deciding about borrowing policy of the company. Every company will have its own policies on HR, marketing, and even finance as well. So some companies says out of total capital, only 20% should be borrowed capital. What is borrowed capital? That is loan. Borrowed capital is debt, not equity. Correct? Debt is owner's capital. Am I right? Is debt owner capital? Wake up. It is not owner's capital. It is third party capital. Equity is owner's capital, right? Okay. Negotiating of finance is a continuous process. So always go for a negotiation. Whenever you go for a purchase of machinery, go for a negotiation. In case the machinery value is in crores, your savings will be in lakhs. Correct? In case the machinery value will be in thousand, your savings will be in hundreds or tens even. Correct? Deciding the cost of financing. What is cost of financing? The interest which you are going to pay for the fund you received. Example, you received loan from bank. That is the fund you received from bank. Cost of financing is the interest rate charged by the bank. Risk. Okay, you are investing in a particular business. What is the risk? Whether you will get the full amount without any problem, or it is 50 percentage profit, or it is a break even point, whatever. That's the risk. Repayment schedule. Whenever you borrow money, the banker gives you the repayment schedule, and you should also have your own plan to repay it. It is always better to repay before the due date. And when you are having bulk money, you try to pay off your loan so that the interest part will be reduced. In that way, you can increase your profit. Otherwise, whatever the profit you earn goes to interest part. Is that clear? Dividend decisions. These decisions are related to part of profit that will be distributed to shareholders in the form of cash dividend, and that amount of profit that will be kept back for utilization by the firm. Okay. Now the profit rises in the business. Okay, end of the financial year, let us say the profit rises. The investors always looking for high level of dividend. Okay. For example, I get 1,000 rupees profit. Mine is a small company. So assume it's a petty shop. So my financial, let us say the amount is in crores. Let us assume that it is in 1,000 crores, whatever. It is not a petty shop example. Let it be a multinational corporate. 1,000 crore profit has come, right? Now you are having 1,000 investors, for example. Are you going to give 1 crore to every investor? Is that so? Definitely not. We will give a part of that profit, and remaining part we will keep it as a reserve. A retained earnings. Every share attracts 1 crore now, correct? So what we can do is we can give 30 lakhs to every shareholder and keep remaining 70 lakhs of every shareholder in the retained earnings. So 70 lakhs goes to company account and 30 lakhs goes to the investors account. Why we need to keep their profits, sir? Because in future you may incur loss. There is a possibility, right? In future you may incur loss. Financial sickness may arise, economic slowdown, anything may arise. That time, the company should survive with the excess funds which you are saving right now. Correct? This is retention money with the company. The remaining part is declared as dividend and it is distributed to all the shareholders. Hope it is clear. What is dividend? What is retained earnings? Correct? Dividend is the amount given to the shareholders. Dividend is Retained earnings is the amount, is the part of profit which is not distributed to the shareholder. So dividend and retained earnings clear. Okay. Determining the amount of surplus to be distributed as dividend to shareholders. This is again coming under dividend policy. If rupees 100 comes as profit, what percentage should be given as dividend and what percentage should be kept as retained earnings. Decisions regarding formulations of dividend policy, and in a periodical way, the dividend policies are revised and rewritten and communicated to the investors. If any investor listening to the class, you'll be getting mail from the company which you are invested stating about the dividend policies, your voting rights, everything. At least every 3 months once you will get a mail from the company regarding their financial position. Decision regarding allocation of profit among the shareholders. That's what we have discussed in the point number one. Ascertaining shareholders' desires regarding return under the tax rate. So, how much shareholder needs? Nobody needs 100 percentage of profit because shareholder is the owner of the company. They want the company to survive and grow. So, they will not ask you 100 percentage of the return. Rather, they look for some lump sum fatty check. Ascertaining stock exchange quotation and behavior of share prices. So all those things are coming under dividend policy decisions. So these are the references. If you get time, you can click the link and get inside. There are many articles about finance and accounts that could help you for the aspirants who are going to become finance professional. From today's class, for any further discussions, doubts, clarifications, you can WhatsApp my number or call my number 9080172288. So, last but not the least, any moral support you want from my side, because in the COVID period, people undergo a type of depression and pain. So, anything, you can just give me a call. We will discuss. Thank you. Happy day.